Hello and welcome back once again, options traders. Well, I received a couple of emails from people, interestingly, asking about the same strategy, apparently because of the recent pullback we had in the market. And they were asking about a put backspread, which is a type of a bearish strategy, and evidently why they were asking about it. There are some benefits with a backspread. I've talked about backspreads in general in previous videos, but let's take a closer look at a put backspread. How do you construct it and why might you use it? Well, again, as a quick recap on backspreads, what you're going to do is to sell a strike. Pick a certain expiration, pick a strike, and you're going to sell it. Usually it will be the at-the-money strike. But you're going to sell a strike, and then you're going to buy two or more of a less valuable strike. So the reason I worded it this way, in kind of an awkward way of saying buy two of a less valuable, is that it depends on whether you're using calls or puts. So this is going to be called a -1/2 spread. The -1 just means you're short that spread, and then the 2 is that you are long. So what this means is that for calls, remember that the higher strikes are less valuable. I've got a video in here talking about option pricing principles, and I usually word it as lower strike calls are more valuable. Well, it's the same thing as saying that the higher strikes are less valuable. And that's because it's giving you the right to pay more for the shares of stock. So the markets will always make sure that for any given expiration, the higher the strike, the less valuable it becomes. Puts are going to be just the opposite. For puts, lower strikes are going to be less valuable. So to construct a put backspread, you are going to, for instance, let's say sell one $100 put and maybe buy two of the 95 puts. So notice what we've done here. We've sold a put and we've bought two of a less valuable put. Lower strike puts are less valuable. And it's in this -1/2 ratio. Okay, so that would be a backspread. Now, in most cases, when you're constructing a backspread, you're going to want to do it for a credit. If your strikes are fairly tight like this, it will almost work out always to be that way. But if you start spreading them out and or start buying a lot more, remember up here earlier I said you could buy two or more. So if you're buying 3 or 4, suddenly that can shift you into a debit, and you've got to be real careful about that. So let's take a look at why. For this trade right here, selling the $100 put and buying two of the 95s, this would be your risk graph. So if it's done for a credit, over here to the right, you can see that we have some type of a profit if the stock price rises. But you can also see that overall, the overwhelming sentiment is that you're bearish. This is where the big profits are. So the main thing that you want to establish this for a credit is that if you're wrong, and if the stock price actually rises, you've shifted this portion of the risk graph up, so that at least you have some type of a profit. Now, probably more important, why we usually like to get a credit for this, is that if this whole blue curve, or at least this right wing over here, is shifted down below your zero line here, what's going to happen is your break even drops much further to the left than if you had just bought a put by itself. And so then you'd really have to question what was the point of selling this option. So that's another reason we want to get this break-even point a little bit closer. You're always going to have a little area or some type of area of potential loss where this graph sits below zero, and then you're going to have these unlimited negative deltas, at least unlimited down to a stock price of zero. So this is the basic shape of a put backspread. Now, once again, you have to be careful about not using debits because you're going to shift these break-evens way down. So let's just say that you got a credit of 2. How do you figure out the break-evens? Well, remember, we could look at this synthetically as a naked put, selling the 100 put, which is exactly what we did in this case. But anytime you see that type of a shape, it is a naked put. So if you've sold the $100 put for 2, this break-even point is 98. Just the 100 strike minus the $2 credit. Now also notice that if you sell the 100 and buy the 95, just one of each, that would be a short vertical spread. 5 points wide, that's the difference in these strikes. And if you got a credit of 2, then your maximum loss would be 3. And you can see that this blue curve right there lines up at -3. So now think about it. If you've got a $3 loss here at 95 and the stock starts to fall, you can think of this as owning the 95 put, because in this case, that's exactly what you have. But regardless, anytime you see these deltas leaning out this way, you also have to be careful about the number of deltas. In this case, we know it's one contract. And that's why I can just take this $3 max loss and subtract it from this 95 strike. And that would give me a lower break even of 92. So if you had purchased 3 contracts, see, now you'd have 200 deltas. You'd bring your break even up this way. And there are different formulas for that. I've talked about that in previous videos. But to keep it simple, we're going to look at the -1/2 backspread. But just for a visual, if you did purchase more, so up to this point we've been looking at selling 1 and buying 2, which would put you on this blue graph. But what would happen if you bought 3? See, now you're going to shift these deltas up much higher, much steeper. If you bought 4, you'd be on this green line. So now you can see why it's bringing these break-even points in closer. Might be a little difficult to see, but where the blue line crosses 0 is at one number, but the red line is further to the right. It's closer to us. The green line's even closer. In other words, if the stock price is falling this way, you're going to hit the break-even on the green curve first, red curve next, and then the blue. So the fewer contracts that you buy, the more that break-even point's going to get shifted out. Now, this might sound like a better idea to go buy a whole bunch of contracts for this reason, but remember, the problem is, as you buy more and more contracts, this right wing over here is going to get shifted lower. And that becomes a problem, because if this portion goes below 0, now look what happens. Now your break-even is going to be way down here, far lower than if you had just purchased the put by itself, or even just did a less aggressive backspread. And so you'd have to say, what's the main reason for doing that? So that wouldn't make a lot of sense. So again, we usually try to get at least some type of a small credit. And that way, if the trade does go against us, we at least have some type of profit. So that brings up a good question. What are the main uses for a backspread? Well, it's quite a versatile strategy. There are a lot of reasons, but probably the main reason is that you're trying to sell at the money high implied volatility. So as I was talking about the past few days, we had this market pullback, and you can see volatility spike in conditions like that. So which option is most sensitive to volatility? It's the at the money. So if you want to sell that looking for this mean reversion, that is the main goal. Maybe we saw the stock usually trading at 20% volatility, and now it's at 40% volatility. Yeah, we might like to sell this at the money option. The problem is that now that's a naked position. And so that would give us the motivation for either doing a vertical spread, just buying 1 of a lower strike put, or buying more, in which case that would be a backspread. Another reason for using a backspread is that you are expecting a large bearish move. As we saw with those break-evens, they can be quite a bit lower. You might be 10% or more away from the current stock price, and that's rare. So even though you might be feeling that there's going to be a big move, it doesn't mean it's going to happen. So you've got to be careful about those break-even points. Now, another way to look at it is tied to this first one here, is that you are expecting mean reversion. You're expecting this high implied volatility to come crashing back down towards the average. But you're saying, you know what if the market's right? What if the market is bidding up this implied volatility from 20% to 40 or 50%? Well, there might be a good reason. Just because it's high doesn't mean it's guaranteed to revert back to the mean, at least anytime soon. So that's another reason. You could say, again, I'm really after trying to sell this high implied volatility, but just in case there is a big crash, let me buy these out of the money puts. So those are some of the reasons for using them. Again, it's a very versatile strategy. They can be a lot more complicated, but I hope that at least gives you a good answer of what a put backspread is and why somebody might be using them. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.